What's up, everybody? Welcome to Generation Urge. So today we're going to talk about last-minute things you can do as write-offs on your taxes. We're getting towards the end of the year. If you have a lot of income, you're going to have to pay a lot of taxes on that income. The more you make, the more taxes you have to pay. The higher tax bracket you're in. So we're going to explain ways to lessen that burden that you have to pay at the end of the year, or maybe eliminate it. So anything else before we get started on them?
No, it's one of those things that a lot of people don't necessarily think about as they're going through the year. What we're going to go over are different things, different tactics, strategies, different things that you can implement in order to help against your heavy tax burden. Because as Dillon was saying, depending on how much money you made, if you made $50,000, $75,000.
By the way, your accountant won't tell you these strategies most likely, so you're going to kind of have to tell your accountant, and then she's going to have to say, or he's going to have to say, yeah, sure, let's do that. And also, don't take our advice, speak to an accountant, because we're not real estate accountants, we're not CPAs. We did both major in accounting though, so we know a little bit about numbers.
A little bit. So the tax brackets for 2022 are 10% of your taxable income if you made less than $20,000, $20,500 for married. For married filing joint. $12,000 if you made between $20,500 and $83,000, again combined. So that's two spouses together, their income combined.
And if you're single, just cut that in half.
Yes, it's essentially right in the middle. And then it really starts to affect your pocketbook at 22%. It's a 10% jump. 22% for what most people make as a couple combined between $83,500 and $178,000. Yeah. It's 22%.
Yeah,
so
combined. Sorry.
It's 22% combined. So then it continues to go up. It goes to 24%, 32, 35, 37%. So depending on what tax bracket you're in, what we're suggesting here is implement these different strategies in order to lessen the percentage or the amount that is going to be affected by that percentage.
And by the way, that's just federal tax. Everyone has their own state income tax. In Virginia, it's roughly 5% for anything you make over like $10,000 or something dumb like that. So chances are just add 5% to whatever those brackets are.
And the suggestions that we're going to make, there are a lot of suggestions that you can take for individuals, right, to reduce your tax bracket. What we're going to be going over are what, as business owners, things that you can do in order to reduce the tax bracket. Yeah. As individuals, you can make charitable contributions, you can make contributions to health, to HSAs, just like in business. There's a lot of little things that you can do. Do you take a standard deduction? Do you take it depends on the individual, but on the business side, there's things that we'll talk about that are a little bit more streamlined that you can implement depending on your tax bracket.
Yep. So first off, we'll get right into it. So section 179, which means if you buy a vehicle such as a truck or heavy machinery that's over 6,000 pounds, you could actually depreciate the whole thing in 1 year. So on December 30th, if you go and buy that vehicle for, let's say, $50,000, even if you get a loan on it, right? So you get a loan on it, so you're not actually putting $50,000 down, but you can depreciate the whole asset. $50,000. Now, when you go and sell it, you're going to have to pay depreciation recapture, but if you just hold that vehicle, you'll never have to pay that depreciation recapture.
Can you give me an example of that? So if I made $100,000 this year, right? And I go and I'm like, I made a lot of money. I've never made this kind of money before. I don't want to be taxed that high, but I need a truck. And I also hear about this one, section 179. And I really like that $50,000 truck. Right?
Yep. So you'll go to the dealership or you'll go to anyone off market. You'll go negotiate the price like you normally do.
So I can do it off market too.
You can do it off market too.
Okay.
Yeah.
So as long as I buy a truck over something over 6,000 pounds that I can drive and use for business, over 6,000 pounds, whether it's on Facebook Marketplace or at a dealership, whether I finance it or pay for it cash. I can still fully
depreciate it. So let's say you bought your income's $100,000. Let's say you bought a $40,000 truck over 6,000 pounds. Now that'll mean you'll only show $60,000 in income. So now you pay taxes only on $60,000 rather than $100,000, which in the long scheme of things would probably save you about 25% on your taxes.
Yeah. So remember what we just talked about, the different percentages. So if you make less as a couple, if you make less than $83,500, you're paying 12% in taxes.
Yeah.
Not 22% in tax, or whatever. I think it's 22%. So that's a 10% savings, and on $100,000, you're saving 10 grand essentially.
Yeah, so you're getting that truck or car, whatever, for 25% off.
Yeah. Okay, awesome. So could we also go over, just so that it's fully thought out, what if I lease a car? I don't buy it, I lease it. Does the same thing still work?
I don't think so. But you can write off what you pay in lease payments. I don't think you might.
So you can't.
Answer. Yeah, so you can't do it if you lease a car, but you could write off the amount you lease.
Yeah. So the way that the IRS treats the lease is just as a business expense. So as you're using the car on a monthly basis and you make those payments, you can write off insurance. You can still write that off on the other ones, but insurance, gas, and your car payment is a monthly expense for your business. If you buy the car outright, so you're buying it or financing it or buying it cash, then you can take the entire lump sum and apply it.
Yeah, they call it front loading the depreciation.
Yeah.
And remember, it has to be over 6,000 pounds.
6,000 pounds.
Weighs.
Yep.
And there's a list on Google.
There is.
Find which trucks and
you can do
cars weigh
SUVs,
that.
vans, trucks, anything over 6,000 pounds.
All right, get on to anything else on that?
No, I think that's it.
Okay.
Next one is going to be buying anything tech. So buying computers, laptops, software, anything that you'll use for your office, again, in order to increase your productivity in business or to make it more comfortable, new screens, new monitors, anything for your office. I would probably even stretch it out and just say anything for your office that is going to help with productivity for your business. You can buy it, and obviously you're spending the money up front. You can put it on your credit card, or you can put it on, or you can just pay for it cash, but that can be a deduction in your business.
And so if your computer's going bad, you might as well upgrade it at the end of this year rather than wait till next year if you want a better computer.
Yeah, if you need maybe an iPad, or you need a mobile hotspot, or you need anything that's going to help you do business more fluidly, you'd want to put that on the front load.
Yep. Third thing, prepay any bills or expenses that you have. So if you have a phone bill and you can prepay for like a year in advance, let's say, and front load that, pay that at the end of December. That way you can get that full write-off right then and there. I think that's how it works. I don't think you have to, even if you prepay, I don't think you have to do that.
Yeah, so consult with your accountant.
Yeah.
Consult with your CPA, because depending on how your business is run, if it's on a cash basis or on an accrual basis, that's how you're going to be able to kind of reflect that onto your taxes. So just run it across them, but you can prepay, and I guess this is just almost like a general thing. You can prepay for services up front that you're going to be using going forward. And an example of that might be like you pre-buying or prepaying for appliances that are going to be installed into a rental or into a house that you're going to be selling next year.
Yep.
You've paid for it this year, but you're not really going to be putting it into the use next year, but you've already paid for it up front.
Yep. And remember to consult your accountant about that.
Yeah. So the next one is, and you probably know a little bit more about this one, is max out your contribution for your HSA.
Yep. So every year, if you have a high deductible health savings account, which means, and you can also look online to see which ones, or call your whoever you have your insurance with to see if it's high deductible. You can actually contribute pre-tax money. I think this year it's up to $3,600 into that, and you can invest that money if you want to. You could put it in stocks or whatever, but it deducts it from your overall income. So if you're making $50,000 and you max out that deduction of $3,600, now you're only paying taxes on roughly $46,000.
It's not a whole lot, but it does help against. I mean, it's the little things, like all these little things. Like, sure, the Section 179 is a big thing. It can really hit your taxes, right? But like buying a computer is not really gonna make or break you. But buying a computer, prepaying for your cell phone, prepaying for bills or appliances, or also contributing $3,600 towards your HSA. I've just mentioned about $10,000.
Yeah, and if you grow your HSA, lend money out of it, you can do whatever you want with it to grow it. You go and spend it, and you don't have to pay taxes on it when you spend it as well. So you grow your $3,600, and over 10 years it comes to $200,000. You spend it on anything to do with health. It could be even a hot tub maybe, because that could help you in health. Then
sauna.
You get a hot tub at your house with pre-tax money that you never even paid taxes on.
Yeah.
at the end.
All right. So
next
then,
one.
Then we have bonus depreciation. So bonus depreciation, I'm gonna blank out on this one. So bonus depreciation is almost like accelerating your depreciation by
Of a house.
cross
Of a property.
of a house by cost segregating, or how would you put it, like getting down to the nitty gritty of all the details of your house. And you usually have a third party come in and do that, where they're just like separating all the depreciable pieces of your house, and they depreciate it on an individual level instead of just like as one asset, right? So it's a little bit more advanced, but it is something that's highly suggested by a lot of people who have been doing real estate at scale, or been doing business at scale, because then you can break down each individual thing. Like, hey, say I have a multifamily and I've run a new electric throughout the parking lots, I've put new pavement out, I've done capital expenditures, like larger capital expenditures. Well, now those things could be separated out and then can be depreciated on an individual level, and that can help accelerate how fast I can depreciate my asset as a whole, opposed to just taking my building and then breaking that down by 39 and a half. Like multifamily, I think is like 39 and a half years or something like that. So instead of like really pushing it out all the way to 39 and a half, I can do like a driveway within like 7 years, 10 years.
I think it's a lot of it's 1 year, I think.
Yeah, a lot of it is, and that's kind of like the cheat code of it.
Yeah, so for example, if you own a house and your cost basis is, let's say, $300,000, and it's an investment property, I think it has to be an investment property, then you could hire one of the segregation specialists, and they'll go in and say, okay, you can take a $150,000 deduction this year and write that off against your income. Now, when you go and sell the house, you have to pay that back as depreciation recapture. But if you don't plan on selling the house or whatever,
or if you decide to die, you could die and then
it just gets wiped if you die.
Yeah. Or 1031.
As of right now.
You could 1031 it too.
Yeah, you could 1031 it.
And then you just kind of kick that down.
Yeah, I don't think you pay depreciation recapture on 1031s. No. Then you just take that whole deduction right then and there, and then boom. That's probably maybe not the easiest, but the most aggressive way. You get a lot of good depreciation there, especially if you have an expensive house.
Right. So the next one, unless you have something else on.
No,
I'm
good.
So the next one is a little bit more creative, and you need to be a little bit more diversified, is selling any losses. So when we brought that up between us two, the first thing that came to mind for him is stocks, right? Because some stocks uptick and then some stocks go down, and it's just the nature of the stock market, right? So then you can almost offset a lot of your gains by selling some of your losers. And some people do it strategically, where they'll buy ones that they know are kind of like shaky and may or may not do it. And if they take a big dip, they're like, all right, well, I'm exiting down, and then it offsets kind of those wins.
Yeah, so if you buy a $100,000 stock and it falls down to, or $100,000 worth of stocks, and now your portfolio is worth 50, you could sell your whole portfolio if you want to for $50K, and you take that $50K deduction.
Yeah, the 50,000 loss.
But also you gotta be careful, because you can't buy the stocks back within 45 days.
Yeah.
Otherwise it eliminates the wash rule. Now you can buy different stocks back, just not those same stocks that fell. So if you had a bunch of Tesla and it fell and you wanted to sell Tesla, you can't rebuy Tesla the next day and take the $50,000 loss. You have to buy something else. Otherwise you'll have to pay taxes. Or no, you wouldn't pay tax, right? Yeah, you would have to pay taxes. Well, you don't pay tax unless you sell anyway, but you wouldn't get that deduction.
Yeah. And of course, we're in real estate, primarily in real estate. Like, can you do that with houses? Sure, you can get creative and do that with houses, but chances are you're probably not going to take that L with a house.
Hopefully you can get a deduction off the house.
Yeah, yeah. But that is possible. So, yeah, I mean, you can take, am I right by saying that you could take losses in other parts of your business and it'll offset the gains? And just like with stock, where you have Tesla that's on the uptick, but then you have, say, Facebook, and that's been down, and you can offset it. Can you do the same thing with like selling your stock to offset some of your gains in real estate on a personal level?
Yeah, if you're a real estate professional, right? I think, yeah, you can do that. So if you take a stock loss, only if you're a real estate professional, I believe you could do this, meaning there's certain criteria. I'd look it up if I were you. I think it's like over 500 hours working on real estate. You take a $50,000 loss in stocks, that can offset some gains you made on, let's say, a flip or rental income. because it all flows down to the same tax return, which is yours at the end of the day.
And some people day trade in order to do, like, they play with day trading, and then when they take the L, they offset like this real estate investments that they have.
Yeah, most likely if they're day trading, they've been taking a lot of L's this year.
Yeah. All right, so the next one is buying tools and or equipment. So depending on the industry that you're in, say for example, if you're in real estate or if you're in, I don't know, vending machines or whatever you might be in, construction, and you need to buy new tools or new equipment. And I'll give you an example. If you need to buy a new dump trailer, if you need to buy new guns, right? Like nailing guns or drills or whatever, or gifting. That's why you'll see a lot of people, a lot of businesses gift out stuff during this time of the year because it's deductible.
Yeah.
So they do make a nice gesture towards their employees, but then it's also deductible on the back end. That's where a lot of people get bonuses on this back end. So if you have employees or you have people that you want to appreciate, you have lenders, you have business partners, you have employees, and you just want to gift them something, you could certainly give them. If you have employees, you want to gift them tools or whatever you might want to gift them. Do it now.
No, you're supposed to 1099 then the amount of it.
You are
the tools you give them.
Yeah, it's still 1099.
Yeah. So here's an idea. Go on your credit card points. Get a bunch of credit or gift cards. Credit card points, and then 1099. And when you give them, it's free write-offs.
That's tax evasion. Do not do that. No.
Isn't that? No,
I don't know. You 1099.
Yeah, you're just giving them a gift card. And last one, I don't know too much about this, but it's a SEP IRA if you wanted to go into detail, or just tell the people to do their research on it. Give them the gist of it, bro.
Yeah. So it's a self-employment pension IRA. So you can make a contribution of up to, what was it, $61,000? I think it's $61,000 a year is what you can contribute. Depends on your income. There's I'm not too familiar with it. I would definitely look it up. But there's a possibility for you, depending on your income bracket, depending on, I think, a few things, you can write off up to $61,000. Or not write off, but make a deductible contribution towards your SEP IRA of $61,000. So that may not be a bad idea for you to look into if you are looking at a heavier tax burden. Now, when you make that contribution, you are going to be taxed on the back end.
Even if you're even older than 60? Even if it's when you retire?
I'm pretty sure it's all gains. They want their money. So you are going to make that contribution now. Sure, it's tax deductible. If you end up having a really bad year in a couple of years and you want to sell at that point, your tax bracket may be completely different, right? So
or convert it to a Roth at that point.
Or convert it to a Roth if politics change or your income level is really low or whatever. It's all strategy. So just kind of take that into account.
And everything with that goes with the traditional IRA, with the 401k IRA or something within your company. It's like a self-employment IRA. I think you can contribute up to $20,000. Same thing, it's pre-tax money, but you do have to pay taxes on it. Even if you're older than 60, you have to pay taxes on it. And if you withdraw before you're 60, you have to pay a penalty on it.
Yeah, it's always
withdraw the gains. I think only actually though. I think if you could withdraw the principal and you still have to pay taxes.
No, you still have to pay taxes.
But there's no penalty if you withdraw the principal.
Yeah. It's just the gains. So that's our piece. We just ran over about eight different strategies. Probably threw an extra one in there. If you have any other strategies that we missed or something that you want to add for people who are watching this video, it's going to be super important for these next couple of weeks. People that need to make some changes and try to save some money last minute. If you're not aware of what your income bracket or your tax bracket is going to be, you know what your income is going to be, you need to call your accountant as soon as possible, figure that out, and then try to see if you can make some changes so that you are in a lower taxable bracket. So.
And before listening to us, make sure you do consult with your CPA because we might not know what we're talking about at all. In fact, we don't know what we're talking about.
I don't know what I'm talking about. But we do have a podcast. Yeah, I don't know. We have a podcast, so everything we say on there, we definitely don't know what we're talking about either.
All right. Don't forget to subscribe,
like, share,
and
hit that notification.
Oh, were you gonna say
Notification bell.
Oh, notification bell.
Urge!